everyone, it's Brianna Paskins, your West Valley go-to realtor here. Today we are going to be talking about how interest rates affect your mortgage payments. So whether you're a first-time home buyer or an investor, understanding rates can save you thousands of dollars. So if this is something you're interested in learning about, keep watching. So what is an interest rate? So an interest rate is a percentage that the bank is charging you for borrowing money to purchase a home. So we call that money that you're borrowing a loan. So if you are going to be purchasing a home, they're going to be charging you X amount of percentage for borrowing every $100,000 essentially. So this is them charging you to borrow the money. And this is a crucial part of mortgage payment simply because the higher the interest rates, the more that you're going to be paying in your monthly mortgage. The lower the interest rate, the less you're going to be paying to borrow that money. There are different types of interest rates. We have a fixed interest rate and an adjustable rate. The fixed rate stays the same throughout the term of the loan, and typically we can do a 15-year or a 30-year for a home loan. And the variable rate will change depending on the market conditions. So the pros for a fixed rate would be that your rate stays the same regardless of whether the market is changing or not. You can always refinance if the market gets lower. On an adjustable rate though, if the market, fluctuates, your rate is going to fluctuate with the market. So if it goes lower, your rate goes lower. If it goes higher, your rate goes higher. So it's not going to be the same throughout the term of your loan, whether that's 15 years or 30 years. So a disadvantage or a con for the fixed rate would be that you would have to refinance if they go lower. But to me, I don't think that's a bad thing because you have the ability to refinance when that rate goes lower. So let's say you got a rate at 5%, and I'm just making up numbers at this point, but let's say you got a rate at 5%. If the market goes down for the interest rates and it goes down to, let's say 4.5, well, you can refinance and get that 4.5 rate. It is not free to refinance. It does cost money. So that would be maybe the con for that, which I don't think is a con because you're able to do that, but that would be considered a con for some people who don't want to, go through the process of redoing their mortgage for another 30 years. So let's say you're in your loan for 10 years and then the mortgage rates go down. You can restart your 30 years by refinancing your loan, or you can pick up and do like a 15-year. So it fluctuates. It depends on your personal preference, whether you want the 15-year or the 30-year. If you do the 15-year, it will obviously be more because you're paying it off quicker. So those would be the pros and the cons for the fixed rate. I personally recommend fixed rate for a lot of my clients, just simply because the rate stays the same. You know what your mortgage payment is going to be like for the next 30 years. If it's the adjustable rate on the alternative end, some cons with that is you won't know what your mortgage payment is going to be. If, let's say in 10 years, the rates go up to 7, 8, 9%, your mortgage payment is going to be higher, right? So you won't necessarily know what it's going to be because it's going to be adjustable. It's going to be fluctuating with the market, and it's going to go with the trends of the interest rates. I definitely don't really recommend this just because of the unknown of not knowing when or how much you're going to be paying and when. I also don't recommend this just simply because it's just not a good, it's available for people for a reason, but it's not a good planning technique or planning strategy to use when you're planning to pay back your mortgage. All right, let's talk a little bit about how mortgage rates are determined. So mortgage rates are determined by inflation, the Federal Reserve rates, and economic growth. And with that, good credit, the better credit you have, the better rates you can get. So I'll go ahead, if you look at this right here, you will notice that if you have better credit, you can get a better rate. The lower credit you have, the higher your rate will be. Like I mentioned, the market conditions, that also has an effect on how rates are determined as well. Right now, currently in May of 2024, we are experiencing high rates simply because of the inflation at this point. So rates are trickling down at this point. I don't know what it's going to be like when you're watching this video, but at this point, rates are considered high. It's about 5 to 6%. I think that is mainly because we came from a 3 to 4% not too long ago, a couple years ago, and to everyone, it's pretty much higher than that. And this is, I would say, considered normal, but because of the house prices increasing on top of the rates increasing, it's really making the mortgage payments higher than what a typical person would like to pay for their mortgage monthly, if you think about income when it comes to that. All right, so right here I'm going to be breaking down an example of how interest rates can affect your mortgage payments. So you have 4 things that come into your mortgage payment. You'll have principal, interest, mortgage insurance, and of course your interest rates. All right, so thanks to Dave Ramsey, I'm using his mortgage calculator. I use his because you can adjust all of the details in the information for the mortgage. So I'm going to be showing you what I'm doing here. So let's play the scenario out. So if you are borrowing on a $400,000 home, and typically the down payment for that would be 6 to 7.5% if you're a home buyer. If you're a first-time home buyer, that'd be 3.5%. That doesn't include the rest of the closing costs. So that would be $14,000 on a $400,000 loan. Okay, now if we're doing a 15-year fixed, I'll show you both scenarios. So if we were doing a 15-year fixed and the interest rate today is set at 6.5, now that just depends on the rates today. I'll post those, what they are today, but you're gonna wanna check what it's like on the day that you're watching this video. So then you have PMI. So PMI is when you are not putting more than 20% down, you have to pay private mortgage insurance. If you put more than 20% down, then you can get rid of the mortgage, the private mortgage insurance, which is considered the PMI. So for this case, since we're only putting 3.5 to 4% down, that's $14,000. We're gonna have to consider the PMI, and that's $322 a month. So just think about that. If you could pay that off, I'm gonna show you what it would be like if you had to pay 20%. So if you put in 20%, that would be $80,000 on a $400,000 home. So if you put that down, you would get rid of your PMI. So you would save $322 a month. But let's, for the sake of this video, let's just stick with the almost 4% down. So that's $322 a month for the private mortgage insurance. And then you have your property taxes. Now this depends per state. Obviously, I'm a real estate agent here in Arizona. So for this, I would look it up per cases. So it would be, I would literally look up the property, look up the tax on that. Typically that's a lot. 4,400 is a lot for here. So I'm just going to stick to, let's say we'll do 1,500. That seems about average for here. And again, that really just depends on the location. So home insurance is an option. They're not talking about mortgage insurance, this is home insurance. So I'll take that off, even though it is per year. I want to give you guys an idea of what would be due. Now, the HOA is not included in your mortgage, so I'm going to take that off too. I want you guys to see what the actual mortgage payment would be like, because not all properties have HOAs. If it has an HOA, just add that on top, because you're going to pay that separate. It's not included in your payment for the mortgage. So these are the only payments that are going to be added on when you are looking at a loan. So if you can see here, it's $3,809 a month for a 15-year fixed. Okay, now if I change that to a 30-year fixed, as you can see here, it says we never recommend 30-year fixed mortgages because we're talking to Dave Ramsey, right? This is Dave Ramsey. He wants you to do 15 years only, which is cool. But if you can't, obviously that's why you have the 30-year fix. So if you look here, you have $3,015 a month. Okay, that is with an interest rate at 7%. Okay, I'm pretty sure I can get you a lower. Let's say if we did like 5.9% interest rate, that drops your payment to $2,700. Okay, so this is the importance of the actual interest rates. Okay, so let's just live in the 2021s and 20s for a second, because the interest rates were, let's say, even 3% at this point. People were paying maybe $2,000 a month. And now that's probably rent, right? If you live here in Arizona, that's rent right now for maybe even like a 2-bedroom. So this is the power of the interest rates. Okay, so if we go up to, we were at 8. So think about it, that same house, you could either pay $2,000 a month or $3,200 a month on your mortgage payment. So that is the power of the interest rate, guys. I just wanted to show you a basic calculation in real time so you guys can get an idea of what that looks like. So if you have a higher rate, that is more being paid over the life of the loan. So if you can see, that's why Dave Ramsey, I mean, I'm a fan of his, but I don't follow everything of his. But for this, I can see why he really likes the 15-year mortgage, because over the life of the loan, you're paying more. So if you pay it off in 15 years, it's quicker, you pay less in interest. So if you think about it, every dollar, they're charging you cents on a dollar to borrow this money. Okay, and if you're borrowing hundreds and thousands of dollars, they're charging you thousands and thousands and thousands of dollars per dollar to borrow the money. If you think about it this way, if you have a lower interest rate, you're able to build equity faster, because when you sell the home or when you're done paying it off, you have to, let's say you sell the home and you have a balance, right? So that balance is going to be taken away. You're going to pay that off when you sell your home. So if you pay it off quicker, obviously it's done, but you can build equity faster because you have more of a window of opportunity to gain that as equity rather than paying that back as a balance due to the mortgage. And the cost of that, obviously, on the alternative would be, if you have a higher interest rate, you're paying more money on the dollar to borrow the money in the whole term of the loan. So some strategies to be able to get better rates would be to improve your credit score, paying off your debt and not missing any mortgage payments, or any payments, not mortgage payments, but any payments in general. You want to make sure you're paying everything on time. That will help raise your credit score, guys. I also have a money playbook that I give to my future clients for free. If you would like access to that, I have the link in the description. Just go straight to that. It's just going to ask for your name and your email, so that way I can send that to your email. You'll have access to that. Look through it. It gives you so much valuable information on how your credit is impacted by the mortgage payments and how you can get better. It's a playbook, so it kind of tells you play by play and how your credit is impacted and how you can do better and get it higher to be able to be a homeowner. I also definitely recommend shopping around. So I have really only used this one lender just simply because he's able to get better rates. He gives also back lender credits to my clients in at least 1%. It's helpful for my clients because it gives them thousands of dollars to be able to buy down the rate in this market. Now, I don't know how long that's going to last, so it just depends on when you're watching this video. I definitely recommend reaching out to me though, so I can connect you with him, because he hasn't been able to beat out any lender that I know. So definitely shop around though. I want you guys to see the difference. So if you want to look, if you have a lender friend, definitely run with them. But I definitely recommend to get an alternative opinion, because it's just going to cost you money just to go with someone that you know, right? And why that lender of yours should be like, hey, like that's going to save you thousands of dollars. You definitely need to go and get that rate. So just think about it that way. We definitely don't want to just be paying extra thousands and thousands just because we're going to use that person for business. So it's obviously personal preference, but I haven't been able to find a lender that can get lower rates than this one, probably because he owns the company, so he's able to do a lot more. So paying points is exactly what he does. So he'll give you a credit so you can pay points down to your mortgage, and that also helps that as well. So if you have any questions or comments for me, please leave them down in the comments section, or if you have any other video recommendations for me, I'm happy to either break this one down even further if there was something that I didn't maybe explain in detail for you, or you can always follow me on my Instagram, where I'm always posting educational tips and helpful information like this as well. But feel free to leave me a comment below if you have any questions, and I will be getting back to all of you who leave me comments and have any questions. All right, so let's do a quick summary of our takeaways for today. So interest rates is money that is charged to you for borrowing money from the bank. Okay, the lower the interest rate, the lower your mortgage payment's going to be. The higher the interest rate, the higher your payment's going to be. There are two types of interest rates. We have the fixed and the adjustable, right? The fixed stays the same and the adjustable fluctuates with the market. We talked about how interest rates are determined and how it impacts your monthly payments. Mentioned some strategies on how to get a better rate with your credit score and shopping around mortgages. And kind of briefly went on the current market trends, although I don't want to get too specific because I don't want to use anyone with different market trends if you're not watching this in May of 2024. If you found this helpful, hit the subscribe button. It really helps this video reach other viewers like you that are interested in learning more about this. Also, don't forget to subscribe so that way when I post more helpful videos like this, you will be the first to know. And also, of course, for those of you who want personalized advice or would like to work with me here in the state of Arizona to purchase a home, or maybe you have any questions you want to speak to me, my contact information is below. You can text me, you can call me, you can email me, whatever's easier for you. I also have social media links down below that you can message me on as well. Thanks for watching, and just remember, your dream home here in Arizona is just one phone call away. Don't forget to hit the notification bell so that way you can be notified when I post that video next week. All right, take care, guys.